Hello everyone, thank you very much for joining me for today's daily snapshot. And today we're going to be looking at Walt Disney ahead of its Q3 earnings release. But before I do that, please take note, pay attention to this important information. Please know that CFDs are high-risk products and you should be completely aware of the risks that they pose. And also please realize that this is a general commentary only and does not constitute investment advice. And lastly, here's our sources of information. Okay, thank you very much for that. Let's get into it. These are some of the fundamentals to take note of with regards to Walt Disney. The Q3 earnings are going to be released after market close today. The earnings per share is forecast to be a loss of 64 cents per share. Take a look at this graphic here. This is a derived weighted basic earnings per share, and we're showing the numbers since the year end September 2016. You can see that the numbers for 2020 are right down. So this is a derived weighted basic earnings per share. We've annualized it, so we've taken the first half, we've added the forecast of minus 0.64 cents per share, we've annualized it, added a weighting, and you can see that due to the sensitivity we're right down this year. Now the reason for that is that the lockdown has affected most of the segments for Disney. There's been theme park closures, cruise ships delayed movie releases, and advertising revenue has been negatively affected. So investors are going to be looking for a number for this pain. How badly has Disney been hurt? The largest segment of revenue is parks, experiences, and products. And, to get people to a park, you need a crowd. But you can't have a crowd because of COVID-19. So we expect a big decline in this segment. And we also want to look at the media segment, which has contributed over 50% to operating income in the previous financial year. Now, the months-long suspension of major sports leagues is likely to take a toll on the media segment. So keep an eye out for that. Disney Plus, that's going to be heavily scrutinized. Is this one source of good news? Is this the silver lining for Disney? The truth is that Disney Plus launched in Japan in June. The release of Hamilton on Disney Plus in July is said to have added a significant number of subscribers. Okay, so this could be the one piece that is some good news for Disney. The truth is Disney's going to be under pressure until there's a vaccine or until there is an improvement in the way that COVID-19 is treated. Let's take a look at the technical chart, and what you can see here is that Disney has been moving in this sideways consolidation, this triangle, since about May. Okay, so these are the converging green lines. More than that, okay, it's broken out, or let me correct this, broken down. Okay, so it's broken down out of this congestion, and it's now sitting at its 20-day simple moving average, and we want to see if that 20-day simple moving average acts as resistance. This red line over here, this is the S&P 500, and right away you can see that Disney has been lagging the broader S&P 500 index. So we've got the price sitting potentially at a simple moving average resistance. It's broken down out of a consolidation pattern and is lagging the S&P 500. We want to just see if the RSI stays below 50 or above 50. If it stays below 50, that will be regarded as a bearish sign. Just to end off, we'll take a look at the key takeaways here. So Q3 earnings is likely to post the first quarterly loss per share in 5 years. The stock is lagging the S&P 500 and price is at its 20-day simple moving average. We want to be looking to see if this poses as resistance. Is this a resistance level? I hope that you found the snapshot useful. If you did, please consider subscribing. Click on the subscribe button below. Thank you very much for joining me, and I look forward to speaking with you in the near future.